to returning inflation to its 2% objective. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. I'll review the current economic situation before turning to monetary policy. Economic activity expanded at a strong pace over the past year. For 2023 as a whole, gross domestic product increased 3.1%, bolstered by solid consumer demand and improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year, payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined, and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices, or PCE prices, rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022 that was widespread across both goods and services prices. Longer-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5% since its meeting last July. We have also continued to shrink our balance sheet at a brisk pace and in a predictable manner. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% inflation objective is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress that we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target rate until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Mr. Chairman. You've acknowledged the Fed likely waited too long to raise rates when prices shot up in 2021. We can't make that mistake again, Mr. Chair, at the expense of workers. If the Fed waits until unemployment starts increasing, it may be too late to cut rates in time to save American jobs. Why shouldn't the Fed act now to prevent workers from losing their jobs rather than reacting after the fact?
So we're well aware of that risk, of course, and very conscious of avoiding it. And what we said is if what we expect and what we're seeing is continued strong growth, strong labor market, and continuing progress in bringing inflation down. If that happens, if the economy evolves over that path, then we do think that the process of carefully removing the restrictive stance of policy can and will begin over the course of this year.
I mean, I know we've had this conversation publicly here or privately also that, working people are hit the hardest with inflation. They're also hit the hardest when companies try to cut costs with layoffs. This town too often seems to forget that maximum employment is part of the Fed's dual mandate. Let me ask you about bank supervision. Senator Scott mentioned that. Last year's bank failures illustrate the need for strong oversight. SVB grew too big, too fast. Fed supervision didn't react decisively enough. The Fed, in response, undertook an assessment of its supervisory process to identify and address gaps related to the speed, the force, the agility, if that's the right word, of its supervision. Explain what concrete steps the Federal Reserve's taken to strengthen supervision in any specific areas where work to make improvements is ongoing.
So this is a very broad area of work. There are, many people in the Federal Reserve System who are involved in supervision, thousands of them, and there's a rule book, and so there's been careful study and thought and a lot of listening to understand how we can meet those goals of being quicker and more effective. Basically, is how I would say it. If you look at Silicon Valley Bank, we weren't quick enough and we weren't effective enough where we were in, and so we're working hard to develop a new rule book and another set of practices, which is still going to be evidence-based and fair, but it's going to involve earlier interventions and more effective ones. And I think this is work that's ongoing and will be for some time.
Thank you. The job of the Fed, of all public officials, is to serve the American people, not their stock portfolios. We've seen abuses in this body. We've seen abuses at the Federal Reserve. I wrote to you last month asking the Fed to identify substantive penalties for board officials who violate the trading rules. Where is that in the process? And I expect these rules in place before the next monetary policy hearing in 6 months. Where is it?
We got our own Inspector General gave us 6 things to work on. I read the list from beginning to end, and the 6th one was what you said, and I just said we're going to do all of these. Let's get going. So we've done 5 of them, and we're working on the 6th.
And it will be finished within 6 months when you're back?
I want to get it right. I certainly hope so and expect so.
Expect so is a better answer than hope so. One last question. More and more, many companies use algorithms that combine competitors' price information to engage in what they call dynamic pricing or surge pricing. You know that corporate PR teams worked hard on this. Just another way for corporations to make it harder for consumers to seek out lower prices and to pad corporate profits. Are you concerned that the wide adoption of these price gouging strategies, these pricing schemes, if you will contribute to inflation?
I think it works both ways. Let me say that, we're well aware of this trend and we're monitoring it. Remember that prices go down when there's no one in the store, and they go up when there are a lot of people. If you're doing dynamic pricing, same thing with the ride companies. It works both ways. I don't know that it has implication for inflation. It would certainly have implications for consumers who need to be informed.
You think that this kind of surge pricing might lower prices overall?
That's my understanding is that the idea is that in slow periods, prices actually go down, and in busy periods they go up.
But these are sophisticated economists working for these big companies, and they're not going to do things to lower their profits.
I think the price mechanism is incredibly important in our economy. I think we need to give companies the freedom to do that as long as they're not fixing prices or failing to disclose the nature of the price changes to the public.
I have a few seconds. Research has indicated constrained supply was behind a significant amount of the inflation we've seen over the last few years. If the supply chain, for instance, of autos had been more resilient, or if there had been more housing availability, would that have made your job easier?
Yes, in a word. Yeah, a big part of the inflation was, and we saw it in 2023 when the supply chain problems unwound, and when the labor supply shock that we had unwound as well. We saw inflation come down very quickly in the second half of the year. But it's also down to, tight monetary policies playing a role as well.
Which leads me to the plea with you to speak out about inflation, about the contribution of corporate profits and greed to inflation. Thank you.
Oh, I know you are done. That's true. Well, I was
Find yourself agreeing with me more and more often? Is that what?
that would be a nightmare, and I'm awake. So, what I would say, however, is that the fact of the matter is that so often, if in fact 60%, I actually listened to what you said, which was remarkable. The fact that 60% of Americans today can't afford $1,000 emergency. I can't imagine how the average millennial affords a down payment for a home. I can't imagine how they take into consideration when they're looking at a snapshot of their financial future, fixing and repairing or having a plan for obsolescence that happens for every homeowner in the country. I think the issue is far more complicated and would love to delve into that over the next 4 minutes and 18 seconds. But my first question is a combination between the challenges of illegal immigration and crime. It seems like every single week there's another story of another city underwater attempting to feed and house millions of illegal immigrants, and American taxpayers are footing that bill. Like I mentioned in my opening statement, just recently in Denver, we saw city workers having their hours essentially zeroed out so that the city could allocate more resources for the illegal immigrants. In San Francisco, they say that the average cost between San Francisco and Oakland, because of crime, is almost $4 billion. Couple that with, in New York, you see Governor Hochul bringing out the National Guard and the state police to help reduce the impact of crime. At the same time, Mayor Adams says he needs more money because the state of affairs from illegal immigrants in the city is devastating the economy, scaring the citizens, and reducing the opportunity for business as usual to return to New York City. So my question is, can you explain how our economy is expected to continue shouldering the burden and the costs because of illegal immigration? And what, if any, information do you have as it relates to the impact of this surge of crime in our major cities on the economic outcomes of those cities? Because I heard the discussion that when you have more folks in the store, you have more shoppers, except for these days, when you have more folks in the store, sometimes they're just there to steal.
So you quoted my statement earlier, and it was an accurate quote, for which I thank you. But I would say right before that, what I said was immigration policy, very important, very much under discussion, and it's none of our business. We don't set immigration policy, and we don't comment on it. So,
but you commented on immigration. So my point, though, is that when you're going to tell a story, please tell the whole story, especially when the nation is frustrated by nearly 10 million folks by the end of this year coming into the country and having the kind of negative impact on prices, on crime, on the challenges that everyday Americans, especially Americans living in the poorest parts of America, face on a daily basis.
So as you accurately quoted, I said over time. So I was referring to the history, which with you agreed. So I was staying as far as I possibly could from the current political context. And it's really not appropriate for us. We're independent. We like to remain that way. And the way we do that, one of the ways, is by staying out of political issues that we really aren't assigned. And so the kinds of issues you're talking about are very, very real. I don't deny that, but they're really not for us.
So the Fed does not consider the impact of 10 million illegal immigrants coming to our country and the costs associated with those illegal immigrants, nor do they consider the impact on states like New York or California or Illinois, where the devastation of crime ravaging the poorest Americans has an impact. We don't take that into consideration.
So we do and so does the Congressional Budget Office. We do try to estimate population, and we try to estimate the effect of immigration, legal or illegal, on the size of the workforce and on GDP. If you look at the Congressional Budget Office has, as you probably know, a detailed assessment of all the things like that. We don't really have a way, and we do look at the finances in the aggregate of state and local governments, that's in the hiring that they do. So that's something we look at, but we wouldn't do a very specific assessment like that. I mean, CBO would, but we wouldn't do that.
Thank you.
Yes, Scott, Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. Before I begin my questions, I want to celebrate that in the past year, we have seen the first Latino Federal Reserve governor and the first ever Latino Federal Reserve Bank president. These are historic milestones that show we are finally making progress, something that I have been at for quite some time, to the leadership of our economic institutions. So I want to applaud that. And Mr. Chairman, I hope that progress can continue and extend to the rest of the Federal Reserve staff.
Thank you.
I agree with my friend, the ranking member, that when you tell a story, you should tell the whole story. Mr. Chairman, are you aware of the Washington Post February 27th article that says the economy is roaring and immigration is a key reason?
I don't recall that, but I would have read it.
Let me read it to you. Immigration has propelled the U.S. job market further than just about anyone expected, helping cement the country's economic rebound from the pandemic as the most robust in the world. It goes on to say, economists and labor experts say the surge in employment was ultimately key to solving unprecedented gaps in the economy that threatened the country's ability to recover from prolonged shutdowns. Would you take issue with those statements?
You know, there are a lot of adjectives and adverbs in there that you wouldn't see in Fed world. But the
Take out the adjectives and give me on the substance.
the story is I think broadly that it is that there was a very significant increase in the size of the workforce last year, and it was happening all during the year, and we were wondering what it was, and the answer was it was really two things. It was labor force participation, but it was also immigration. And if you look at the Congressional Budget Office numbers, it kind of makes sense because there was a lot of growth. Wages were coming down, the economy is bigger, and those are probably in part affected. This is without making any judgments on immigration or immigration policy, but I think that's an economic fact.
I'm not suggesting that. I'm just suggesting the facts are that we had 10 or 11 million jobs that were going unfulfilled in our economy. They lacked the productivity that is necessary for success economically. And as part of that, clearly, immigration helped fuel part of our revival coming out of the pandemic. In fact, those were the people who were the essential workers when the rest of us were staying home. So I agree we need to do what is necessary to have a regularized border, but I also think that just to create the context of immigration as a scourge is absolutely wrong. Let me turn to another question. In my view, the sticky inflation we've been seeing in the housing sector is principally due to the massive nationwide housing shortage. The Fed's Monetary Policy Report attributes the shortage to restrictive zoning, high interest rates, and tighter underwriting by banks. I would also add to that list underfunding of key HUD programs that shore up and expand our supply of affordable housing. If the housing supply shortage continues to grow, are we likely to see continued housing inflation?
Yes, we are.
And housing is already becoming less and less affordable for low and middle income Americans. According to the National Low Income Housing Coalition's 2023 Out of Reach report, a worker earning the minimum wage in New Jersey would have to work 2 full-time jobs to afford a modest one-bedroom rental home at fair market rent. Do you agree that increasingly unaffordable housing is a problem for the economy?
I think there are two things going on. One is a longer-term housing shortage, and the other is the pandemic effects and the associated higher interest rates, which are things that will pass through. When all that passes through and rates are normalized, we'll still have the underlying housing shortage, and it's going to be causing upward pressure on housing prices.
Now, the Monetary Policy Report noted that, quote, home purchases by low-income households have fallen disproportionately more because mortgage lenders impose maximums on the ratio of a borrower's debt service payments to the borrower's income. I'm worried about how this dynamic will interact with the recently proposed capital requirements proposal, which, according to analysis from the Urban Institute, would disproportionately increase the cost of mortgages for Black, Hispanic, and low and income moderate borrowers. Given this, isn't there a risk that if the capital rules implemented without changes, that it could make it even harder for disadvantaged borrowers to attain home ownership?
There is a risk like that, and we're very focused on it.
And hopefully you're working to mitigate it.
Yes.
Thank you. Thank you, Mr. Chairman.
Thanks, Chairman. Senator Rounds from South Dakota.
Thank you, Mr. Chairman. Chairman Powell, welcome back. Look, first of all, I've appreciated the way that you've approached the discussions in front of this committee, and I understand your desire to stay as neutral as possible with regard to the politics involved in an election year. But I do have some questions here, specifically with regard to the Basel III Endgame proposal. An analysis of that proposal found that 97% were either opposing it or expressing substantial concerns. In the hearing last March on the Monetary Policy Report, you stated that the Federal Reserve is a consensus organization, and you said, and I quote, I will do everything I can possibly to bring people together in consensus and have a capital framework that could be broadly supported. My question to that is, do you currently believe that there is a consensus on this capital framework?
I believe that we will have one. I'm fairly confident that we will have such a consensus when we do move forward.
So we could expect that you will probably not call a vote on the proposal until you believe that there is a consensus?
I think that's right. I mean, we're just in the process of digesting the comments and then making the appropriate changes.
Thank you. As you are aware, I've weighed in several times on the concerns that I have with regard to Basel III Endgame, including I'm concerned about the lack of transparency, the negative effects on mortgage lending and home affordability by disincentivizing banks from offering high loan-to-value loans that primarily help first-time home buyers and low to moderate income borrowers. I'm concerned that the proposal will make buying a home harder than it already is for many. And further down the road, I fear that it could disincentivize mortgage lending from the largest banks, particularly with regard to the secondary market and their impact on even smaller banks that do business with them. Would you be willing to withdraw the proposal or re-propose with significant modifications, particularly addressing the concerns that I and others have on this committee, raising specifically with regard to the impact? And I'm thinking of Freddie and Fannie in particular and what the impact might be. What would you see as the process involving those particular issues?
So on those issues, we're well aware of and very focused on those issues. We haven't decided what to do about that yet, but we get it on those issues. In terms of process, we're not at the stage of making that decision. I will say, if it turns out to be appropriate and we get to that point for us to re-propose parts or all of the thing, then we won't hesitate to do so.
Okay, thank you. Makes me feel a little bit better because I do think there are some very serious problems that would occur if the Basel III Endgame as proposed goes into effect. And I most certainly am hoping that the Federal Reserve will find a consensus on this. And it sounds like that may very well include some significant modifications if it were to be brought at all. Is that a fair statement?
I expect there will be material and broad changes to the proposal before it comes back to the committee for consideration, the board for consideration.
Thank you, sir. Let's just, with regard to the economy today, a limited level of price growth is believed to help facilitate economic expansion, reduce the risk of recession, and help businesses and consumers plan. However, during the Biden administration, we saw inflation climb to 13%, and those prices are now the new norm. I know that you make it a policy not to comment on the administration's fiscal policy, but it is well known that I really do believe that high inflation and high prices have been a direct result of President Biden's policies, failed in many cases, that the Federal Reserve has limited tools to address some of the problems that these policies created. We talk about supply side versus demand side on these costs. What have been some of the unintended consequences from raising the federal funds rate as rapidly as you felt that you had to as the chair and as the committee? What are some of those? I know that we talked a little bit about SVP and the failure there, their inability to look at treasuries and the increasing interest rates and so forth, but can you talk a little bit about some of the things that you've seen that were negative with regard to trying to respond to those high inflation rates?
Yes. So high interest rates are hard for businesses, they're hard for people. They're the thing they're the tool that we have to use to bring inflation down. And our job at this time, when high inflation comes, it is the Fed's job to restore price stability, and that's what we're doing. You point to the losses in banks. That was a very substantial thing, and obviously the supervisors, and that was us, didn't get to that problem. We were aware of it, but we didn't probably appreciate it enough. Another surprise, though, is that we were able to get this far and get inflation down this quickly without seeing a big increase in unemployment, and that's just a great result. That's just a surprise. It's not consistent with the historical record, but it's a really positive thing.
But thank you. And I would just know the only tools you had available were demand side tools.
Yeah, that's right.
Thank you. Thank you, Mr. Chairman.
Thank you.
Senator Warner of Virginia is recognized.
Well, thank you, Mr. Chairman. Chairman Powell, it's great to see you. I would point out to my good friend from South Dakota, I do think, if we'd gone back a year to 18 months ago, nobody would have predicted a soft landing. And I know you're not ready to declare victory by any means, but the fact that inflation has come down, and I actually think some of the things like the CHIPS bill, the infrastructure bill, and some of President Biden's policies have actually kept the economy growth rate at the levels that have allowed you to bring down inflation without seeing a dramatic rise in unemployment. And again, that'll be something we'll probably have the opportunity to litigate over the next 8 or 9 months. I want to take my time on issues around less about monetary policy and more about regulation. I think we can never presume that we're out of the woods on financial stability, as we saw with the New York Community Bank yesterday, the stock plunge and the capital infusion. One area that I raised with you a year ago, I want to re-raise today, and that is non-bank lending. The fact that non-bank lending in terms of to non-financial firms now is actually exceeding regulated bank lending. And let me be clear, I've got, the non-bank financial sector has done productive things in our society over the years. But when folks like former New York Fed President Dudley and former Fed Governor Grosvenor recently said that they had worries about this reliance on the non-bank financial sector could lead to overall economic lack of stability. I guess, what do you think, I've got a 3-part question. What do you think are the risks as we see this push-out effect of more and more lending going outside the regulated perimeter to the non-bank sector? How much do we really know about these institutions? And one of the things, they have very smart, sophisticated investors, but if those very smart, sophisticated investors said, well, hey, we don't like the lending profile right now, and we want you to not make any additional loans for the next 6 to 9 months, do you think our system would be able to pick up the slack?
So we have the regulated banking system where you've got a lot of transparency, you've got deposit insurance, you've got access to the discount window and all those things, regulation. If you go outside that, most of the funding that we see now in these vehicles is sophisticated investors who are actually limited partners, meaning they can't pull their money out. They've signed a contract, they've funded these deals. And so what you see now in the non-bank financial sector is significantly, it's that kind of thing. So it doesn't have the run risk. The point is, the bigger it grows and the more diverse it gets, it is happening outside the regulatory perimeter, and you worry that when there is another crisis, you'll be surprised, but there will be ways that financial structure too can break down, and it does break down in ways we don't anticipate. So I think we need to be smart about the way, about intermediation is absolutely moving out of the banks into the capital markets and into non-bank financial institutions. That's what's been happening for a long, long time. I just think we need to be thoughtful about understanding where the risks are emerging.
And that sophisticated investor may rightfully say, hey, we don't want you to lend anymore for X period of time, but that may then, at that moment of crisis, mean that the lending capabilities completely dry up. And one of the things I never completely understood until I got a little better explanation recently, why the large regulated banks weren't more complaining about this non-bank lending, but as I got to understand a little bit more of the, and again, I'm not per se criticizing on the non-bank lending, but many of the regulated banks actually lend to these large institutions, so they make money off of those relationships, and maybe that's again an explanation of why they're not being more critical. I only got 40 seconds left, but I would like to come back to another thing that we've talked about a lot, and that is the question of use of the discount window. I believe one of the original tools that the Fed had, I know banks say, well, we're concerned about the stigma. I've got some legislation that would actually require mandatory use of the discount window. I'd love your comment on that. And also just the idea that having the mechanics of the discount window open, potentially even 24/7, because we saw with SVB, they didn't know how to use it, but two, if they wanted to use it in the non-bank hours, could they get access?
There's a lot of work to do on the discount window. You're absolutely right. It needs to be brought up technologically into the modern age. We need to do more to eliminate the stigma problem, and we need to make sure that banks are, actually able to use it when they need to use it. And those things, that's a broad work program that we're on right now, and it's very important.
I know you're working on it, but I would look forward to working more, and I'd invite other colleagues. I really do think before we start adding a whole host of the other regulatory issues, we ought to use some of the tools that are out there. You're not gone.
So, God, I just checked in at the Veterans Committee Center, Tillis, North Carolina. Thank you, Mark.
I was about to take control, Senator Warner. Welcome, Chair Powell, and Gus sends his regards. If you have time after the hearing, you ought to go by and see him. He's a dog in our office. But
I don't want to disturb his nap, but
but thank you for being here. I want to get back on this Basel III proposal. Senators Lummis, Coons, Gillibrand, and I sent a letter indicating our concerns with the current proposal. But I think it's also worth noting that the number of other organizations, a diverse group that are not normally aligned on policy. You got Bank Trades, National Housing Conference, NAACP, Habitat for Humanity, National Community Reinvestment Coalition, the list goes on, who have concerns with the current proposal. Here's my concern. I think we're trying to make the best of what was foundationally a bad proposal. And so I'm in the category of people who think that it should be reproposed, because I think one of the reasons why I did not support Mr. Barr's nomination is I felt like we were going to be here. I mean, it was pretty clear to me before he ever got confirmed on the board that we were going to be in this place some months or years later. And here we are. And I think that the industry felt the same way. All of these stakeholders, some of them are in banking trade, some of them are on the other side of the spectrum. So I'd like to cast my vote or provide some weight to the idea that we should repropose it. And what we ought to do is talk about the reality of increasing capital, or the prospect of increasing capital requirements doesn't concern me. I think the prior Fed supervisor had made comments publicly that maybe we needed to raise capital standards. But what we did hear in this proposal, and I heard in that dialogue, is let's deal with puts and takes. Let's talk about raising capital requirements, but let's also talk about reducing the cost of the regulatory burden today if we can do it responsibly. There's no evidence of that in the current proposal, and I think that may actually produce a different set of comments that would be instructive to a final proposal that I think realistically will include some increasing capital requirements. So over what time horizon do you think we would expect to either try to make the best of this foundation or go back and take a look at a new foundation and repropose it?
we're going to work through it as quickly as we can and should. I will say it's more important to get it right than it is to do it fast. We're not in a hurry. But my guess is we'll work this out over the course of this year.
Yeah. Well, if you take a look at the outsized cost of operational risk, the long list of concerns that I have publicly and privately expressed on the current proposal, I do think sometimes it's easier to knock down what I think is a poor foundation and build a better house. So again, just wanted to make that comment publicly. I got a question about shrinkflation. I tell you, some of these words that we come up with, but President Biden's using the idea of shrinkflation and chastising manufacturers for creating smaller portion sizes for potato chips. I'll use that as one example. But if you have rising input cost, and you're not able to control that, and you're in a marginal business to begin with, and now you're saying you can't even reduce the quantities, how does a business that's not making a profit make that work?
I mean, we see inflation at the aggregate level as a mismatch between supply and demand.
Yeah.
And as we've seen supply get better and we've seen demand cool off a bit, it was very hot coming out of the pandemic. We see inflation coming down.
We saw food inflation between 2010 and 2021 at 18% over 11 years. And over the last 3 years, we've seen it at 21%. I think that we have a industry that's trying to actually provide products that consumers want, and now they're being chastised for trying to figure out how to make the numbers work. So this whole idea of shrinkflation is just confounding to me. I'm going to submit some for the record. I want to stay on time. But I have a question. I think the chair mentioned, if I misunderstood this, I'm sure the chair will clarify, but I thought in his opening comments, he suggested that stock buybacks and paying out dividends were a key factor in inflation. Do you, as just a matter of policy, see stock buybacks and dividends as one of the top 5 reasons we're experiencing the inflation we have right now?
First, I guess I see stock buybacks and dividends as just the same thing in a different form. And I don't know, I wouldn't comment on anything the chair even may have said.
Well,
I'd like to avoid that.
I don't think, I'm not going to ask you about policy because I think you're consistent on that, but I just can't imagine that if we decided to outlaw stock buybacks and dividend payments, that would have a material effect on inflation. So I'm not going to ask you to respond to that, but there are some people that by inference you could assume that they think that would be helpful. I just, for one, I'm not an economist, but I just can't imagine that it would be one of the things that would make your job easier. Can you at least opine on that?
Banning stock buybacks and dividends? Yeah, I think that would be quite a change in our capital markets.
Yeah, me too.
I mean, shareholders, this is just money going back to shareholders from companies that have nothing to do with it.
Okay, thank you, Mr. Chair.
Well done, Senator Tillman. Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. And thank you, Chair Powell. It's great to see you here again. I appreciate your testimony. And I'm going to focus my questions on housing and housing affordability. As you have well pointed out, overall prices have moderated considerably since the Fed began raising rates, yet housing costs have remained stubbornly resilient or high, leaving us really no closer to addressing the affordability crisis that I think that we have, and this was there well before the pandemic. Shortly before the Fed began tightening, Chair Powell, and you came before the committee, I asked you about how higher interest rates could exacerbate this unaffordability problem that we have by making mortgages more expensive and also hindering housing development. And I think that at the time you argued that we have a excess housing demand during the pandemic, and that was kind of at the root of higher costs, and that your goal, the Fed's goal, was to bring demand closer in line with supply. So my first question is this. So the housing market has cooled significantly over the last 2 years. Is it your view that it has cooled enough so that housing supply and demand is better in balance? And following on that, given the Fed's limited tools, understanding that, at what point will you think that you've done all that you can to lower housing demand? My view is that we're well past time in Congress to take action on the housing supply side, but I'm interested in how you see this dynamic.
So we're not focused so much on housing and housing inflation. We're really focused on the aggregate, which is also
Yep.
goods and non-housing services. That's way more than half of the PCE inflation. There are things in the housing sector that we didn't fully anticipate. One of them just was that people in very low interest rate homes with very low interest rate mortgages aren't selling.
Right.
So the quantity of homes that's available is incredibly low, and that's why it's very little in the way of existing home sales, and that drives up existing home sale prices, but also new home sale prices. So again, there's two sets of factors. It's the longer run issue, but then there's the factors associated with the pandemic and the inflation and our response to it. I think as the overall inflation continues to come down and rates then come down, you'll see the housing market start to heal and get better, and housing affordability should go up again. But you're still going to be left with the longer term problem of supply.
Right. I think that's right. I mean, what I see in Minnesota is that higher interest rates are, of course, driving up the cost of construction. They're driving up the cost of mortgage rates. You're seeing people who aren't leaving a house that maybe is a little too small for them because they can't afford it, that the housing, just as you're saying, people are staying in their homes longer. And so there's sort of this double whammy of construction slowing at the same time that there is this great need to address housing supply. One of the things that is happening, it's interesting, a recent analysis by Zillow found that the monthly mortgage payment let me get this right. A recent analysis by Zillow found that the monthly mortgage payment on a $343,000 home, assuming 10% down payment, is about $2,200 a month. Okay, so $2,200 a month, that means the cost of owning a typical home is higher than 30% of median income, which is kind of the measure of affordability. And so we've got a lot of issues with people just being priced out of the housing market. So from where I sit, the cumulative issues of higher mortgage rates are just really a challenge. And until we can get to the bottom of that, we're going to have a hard time addressing the housing affordability challenge that we have. Would you like to comment on that?
Yes, I agree with all of that. I mean, home prices don't actually go into the calculation of inflation. It's really rents and
Right.
owner's equivalent rent. But I agree, the housing market is in a very, very difficult situation. And, the sooner we can get back to price stability and restore interest rates to lower levels, the sooner it can start healing.
Yeah, thank you. Thank you, Mr. Chair.
Thank you, Senator Smith. Senator Kennedy of Louisiana is recognized.
Mr. Chairman, thank you for being here. Thank you for your services. I think I've said before, I believe you and your team probably saved the world economy during the pandemic economic meltdown when the whole world wanted dollars by establishing the currency swap line. So I thank you for that. You gave an interview, Mr. Chairman, on February 4th of this year to CBS, 60 Minutes, I think. Is that right?
Yep.
I ordered a transcript of that hearing, which I read. I learned a lot reading it. You were asked a question about inflation, and you asked a question about prices declining. And here was your response. I'd like to quote you, if that's okay. Quote, "So the prices of some things will decline, others will go up, but we don't expect to see a decline in the overall price level. That doesn't tend to happen in economies except in very negative circumstances." End quote. Did I quote you accurately?
I believe you did.
Okay. Later in the interview, you were asked about the national debt. Do you recall that?
I don't actually, but I'm sure that's right.
Okay. Well, at least according to the transcript, your answer was, and again, I'm quoting you, "In the long run, the United States is on an unsustainable fiscal path. The U.S. federal government's on an unsustainable fiscal path. And that just means that the debt is growing faster than the economy. So it is unsustainable, end quote. Do you remember saying that?
I've said that many times. I think that's uncontroversial.
Okay. Later in the interview, you said, I want to quote, "You know, I would just say this, integrity is priceless. And at the end, that's all you have. And we plan on keeping ours," end quote. Is that an accurate statement?
Yes, it is.
Okay. That's why I want to ask you about the FDIC. Have you read the article in the Wall Street Journal entitled, quote, "Strip clubs, lewd photos, and a boozy hotel, the toxic atmosphere at bank regulator FDIC," end quote?
I think I did read that a couple months ago.
Did you read the article entitled, I quote again, "FDIC lawyer stayed on paid leave for weeks after child porn arrest," end quote?
I don't remember that one.
Okay, did you read the article entitled, also in the Wall Street Journal, quote, "FDIC chair, known for temper, ignored bad behavior in workplace," end quote?
Honestly, I don't. I read so much, I can't, I remember the broad story, but not particular stories.
Did you read the article in which a former female employee of the FDIC allegedly recalled her male colleagues saying women needed to use sex to get ahead at the FDIC?
I do not recall that, no.
Okay. Did you read the article in which a female risk management examiner during a lunch with a male examiner said she had become friendly with that examiner, and he complained to her about his marriage, allegedly, telling her he wasn't getting enough sex. And she allegedly said, quote, "Obviously, if I walk," or he allegedly said, "Obviously, if I walked into this office and you were naked, I'd fuck you right here," end quote?
I do not remember that, and I think I would.
Okay. Do you remember the article about Mr. Randall Ditch, a supervisory examiner in Denver, who allegedly was demoted in 2014 to a non-supervisory examiner position in Tulsa after having sex twice with a subordinate female employee and a number of other rule violations? In this article, it says, allegedly, Mr. Ditch had urged the woman to not, quote, "be a pussy," close quote, and drink a shot of whiskey during work hours, the records show. Do you recall that?
I do not recollect that.
Okay.
No.
Here's my question. I could go on for a while.
Could go on, but you're not gonna go on, so you've passed your 5 minutes. Do your question once.
Sir?
Senator Kennedy, your time's already expired. You can do one. You did 5 minutes, consumed the whole 5 minutes with your monologue of,
Well, you did 6 minutes. I timed it.
I asked my,
You did 6 minutes.
Senator Kennedy, for months, I have let you go way over the 5 minutes. You get your question,
But you did 6 minutes.
I chair this committee.
I understand. You still did 6 minutes. Check the record.
I'm gonna order, you're gonna be at 6 minutes and 15 seconds if you continue this argument,
Well,
or
that's-
you're gonna ask your question.
I'll ask my question. I just wanted the record to be clear, Mr. Chairman. Mr. Chairman, in light of these allegations, if they're proven, how can the FDIC lead this charge for Basel Endgame 3, which is going to turn the banking community upside down?
I don't know how I would make the connection to Basel III. I'll say this is deeply troubling things, obviously, but again, as your point was, if proven. And I think we have to decide Basel III on its merits, and we're not looking to the FDIC to lead this, by the way. We're looking at the Fed to do what the Fed thinks is right. That's what we're gonna do. We don't look to, and they don't look to us to lead them.
Thank you, Chair Powell. Senator Butler is recognized.
Thank you, Mr. Chairman.
Thank you.
Senator Butler is recognized.
Thank you so much, Chair and Chair Powell. Good to see you in person, and thanks for the time to talk. I want to pick up a little bit where Senator Smith was in relationship to housing affordability, and hopefully draw a little bit on the point that you were making about rents. It definitely is an important crisis in my state of California, and I know across the country, where, at least according to the California Department of Housing and Urban Development, renters in San Diego are paying about 50% of what is, they're spending more than 50% of what is considered affordable. And statewide, the majority of renters, more than 3 million households, are spending more than 30% towards rent. Nearly 1/3, more than 1 in 5 million households pay more than 50% of their income towards rent. And the Chicago Fed President Goolsbee even referred to housing as a missing piece of the puzzle in the Fed's path to lower inflation. So to the continued conversation, and I know a point that you've made that about how inflation has a disproportionate impact on lower income households who are focused on spending more of their monthly budgets on housing. How is the Fed's monetary policy impacting the supply of affordable rentals?
I don't know that we're affecting the supply of affordable housing. If you think of affordable housing as something that's connected to some sort of government program, that's not our bailiwick. I mean, clearly interest rates do affect the affordability of housing, though.
And there was a key point that you made in an earlier, I think, reference about, and in your response to Senator Smith about the monetary policy in the calculation of rents. Can you just spend just briefly talk about that? I want to have one last issue I want to get to before I run out of time.
It's hard to talk about it briefly. It's actually very conceptually challenging to think about housing inflation. Do you include the costs of financing it? Do you include the sale prices? And the answer is we don't. We convert ownership into an imputed rent, and that's 2/3 of homes are owned. And then we actually measure rents, but leases only turn over once a year. So you look at market rents, and what's happening with newly signed leases may be very different from what was happening a year ago. So it's complicated, but the good thing is we understand all that, and we look through that. We look at housing services overall as one of the 3 important categories, along with non-housing services and goods inflation.
Thank you for that. In the line of affordability and housing, again, sort of very general, I think, to the broad monetary policy and state of our economy and unique to California. And I raised this with Secretary Yellen when she was here as well, the insurance gaps that are presenting themselves due to the impact of climate change. Where 1 in 5 residents in California live in areas that risk flooding, and all 58 counties have a history of flood damage. And we are seeing more and more home insurance providers actually withdrawing from the state. You and I had talked a little bit about this in our preparation for today's conversation. Can you talk to me about or share with us how it is what you think the impact might be of this sort of protection gap in insurance coverage